Hey everyone, this is part 2 of my interview with Chris Marchese and David Morgan, talking about their newly released book, The Silver Manifesto. In part 2 of this interview, we discussed the silver bull market as it stands today, the supply and demand dynamics behind silver, and why the biggest moves in silver are yet to come. Alright, well I'd like to transition now to the silver bull market. So David, did you want to discuss some of the supply dynamics behind silver that you wrote about in your book?
On the supply side, we've had quite a ride in the silver market. I mean, basically, you can look at it from a long-term perspective. And if you go from, let's say, roughly the 1900 to about the 1990 time frame, the most silver you got out of the ground was about 365 million ounces a year. And our predecessor, the silver guru at the time, Jerome Smith, made a lot of his conjectures on the fact that the ceiling on silver's production or supply side was 365 million ounces a year. And if you looked at the data, he was correct. Up until there's a big shift in technology and you were able to use cyanide heap leaching, which was a big change in the mining industry and allowed the production to increase dramatically in precious metals and other mines. So not knowing the future, and none of us do, that was a big mistake that he made in his analysis. In our analysis, I'm always open to some, major change taking place in the mining industry, which I may not be aware of presently or no one else is presently. So what we saw was a flat production rate once we got through that big change around that time frame, and we had a silver deficit from 1999 to 2006. And since the commodities boom driven by China took place, we saw production increases throughout the base metals area, which includes silver, because 70% is a result of base metal mining, and gold production, and of course primary silver mines. So there's this big push into the commodity sector, particularly in the metals, and that drove production much, much higher. But the idea is that the supply demand is, the idea is that the supply was flat and in a deficit for 16 years. Then we reached equilibrium. And really, we've been in equilibrium all the way for from 2006 to 2015, the last 10 years or so. Now, it could be argued in one of the major silver studies, in fact, both at the time, during some of that time frame, would say there was a silver surplus. But the market basically takes care of it. I mean, there's no silver just hanging out that isn't wanted by somebody at some price. So it's always taken off the market, either warehoused for an industrial purpose or taken off as an investment by somebody. If we look at overall demand, we've been in a slight deficit according to the GFMS study the last couple of years. But the overall deficit has been the major story about silver on the supply side for a very long time, because the amount of silver that's come out of the ground in all of recorded history is roughly 50 billion ounces. And we're down to maybe 2 billion ounces of what is considered to be investment grade silver, meaning coins and bars. So that's a lot of silver that's been mined, but the amount that's available for investment is extremely small.
Now, turning to Chris, did you want to discuss some of the demand dynamics in the silver market that you discussed in the book?
Yeah, well, basically, we break it down into the two demand drivers. That's investment demand and industrial demand. And going forward, silver really came into its own, aside from photography, in the early 2000s, because that was when everything started to kick into high gear for all the new technologies that were available and all the new electronic devices. And like today, your iPad, iPhone, and all those type of things, they all use very small amounts of silver, but when you combine it, it has been more than mine supply. It's the secondary supply or recycling that has made it so the supply is greater than actual consumption. But that should begin to flatten out as we see. We don't know when peak silver is, but we do give estimates based on the new mines coming online. And, we, of course, give heavy discounts to mines that we don't think are going to get online, such as Pascua-Lama. And so at the latest 2023, 2024, supply it won't grow anymore unless, like David said, there's some new technology that's available. But the thing is, industrial demand won't suddenly increase. So it'll gradually increase. And I think by not next decade, but the following decade, just the industrial consumption aspect will be greater than primary and secondary supply. And in the meantime, it'll be investment demand due to, the reckless monetary and more notably fiscal policy around the world. For example, in chapter 9 of the book, The Debt Bomb, we provide all the true debt to GDP numbers, which no one really hears about because we take total net debt, not just government debt. So that's household debt. By the way, the U.S. has the highest household debt to GDP of any medium to large size economy. And debt held by corporations, debt of financial institutions, which isn't including corporations. And so, the future is very bright for new industrial uses. And, there's a lot and we give a lot of them, but, there's also an endless amount that we don't know that will be available, even next decade.
Now, you both mentioned in the book that the biggest moves in the precious metal markets you see coming in the next 2 years, and that the bull market will not be over until about 5 to 7 years from now. Starting with Chris, did you want to talk a little bit about this?
Yeah, there's a breaking point until everyone recognizes that these debt-laden economies is just unsustainable. And that's the earmarking of every currency crisis throughout history, is that they're just absolutely laden with debt. It's not just printing a lot of money. They print a lot of money because, they've run out of debt financing. And, I actually think when this bull market is over, I don't think silver or gold will return to the price they otherwise would be at, just because there's, I think, a certain proportion of the world, perhaps even the majority, will then view gold and silver as what they are, money. And in that case, elevated prices would remain.
So, David, did you want to discuss a little bit about why you think that the biggest moves in precious metals are coming in the next couple of years?
I see the biggest move ahead because I've lived through not only the precious metals bull market, but I've been through the tech wreck. I've been through the 87 crash. I've got some gray hair. So I've seen markets and I've studied markets my whole life. And the end of the bull market, usually we would have a peak in all the metals at the same time, or nearly so. In other words, you'd see platinum, palladium, gold, and silver all making new highs or close to it. And what we saw in this run-up that we witnessed up to 2011 was that silver peaked in the last day of April, and gold didn't peak until September, several months later. And he also didn't see what a top consists of, which would be the mainstream media taking note of the precious metals. You'd hear about gold on the front page of Time magazine as a quick example, or the New York Times would be talking about the overspeculation of the gold market. None of that took place. So, and the more important part is the fundamental fact that none of the problems that existed during the financial crisis of 2008 have been rectified. In fact, they've only been made worse over the last several years. And the recovery really is not meaningful or substantive at all. It's a lot of printing. So basically what I'm saying is this. We haven't seen from either the fundamental perspective or technical perspective the top of the market. Now, whether it's 2 years off or 10 years off, I really don't know. What I really tried to put forth in the book with Chris is that the best lies ahead. And what we saw in the last bull market is that 90% of the move comes in the last 10% of the time. And what we could look forward to, because once the metals correct all of the imbalances that have taken place in the financial system on a global basis, you're probably not going to believe the actual price of what these metals can reach in paper terms. But if you just do a simple true money supply divided by the purported amount of gold that the U.S. Treasury says it owns, which is doubtful in my view, I just wanted to throw that in, you would come out with about $11,000 an ounce for an ounce of gold. And if silver outperforms gold, which I believe it will strongly, then even at the current ratio, you could divide it by 70. But if you go to the ratio that I expect, I mean, I could get to 1/10 the price of gold, which is just an unbelievable number of 1,100 an ounce. Now, I'm not saying silver's going to 1,100 an ounce, and I'm not saying that gold is going to 11,000 an ounce. But what I am saying is that if you go back to 1980 and you did that same arithmetic problem and you took the amount of money in the true money supply and divided it by the purported amount in the U.S. Treasury of gold, it came out to $400 an ounce, and gold went to $850 an ounce. So it overshot by a factor of 2. Now, does that mean the next time that gold will overshoot the theoretical gold standard price where you could put all dollars backed by gold? I don't know. But what I do know is what happened the last time. So to say that, this $5,000, $10,000 gold is out of the question, I don't rule it out because I saw it happen already. So that's the idea, that the biggest move lies ahead. And I think when this thing really gets going, that people that bought silver, $25, $30, $40 even, are going to, if they've held it, be very, very grateful that they did. Now, that's my opinion. That's my belief. Will that guarantee that this is going to take place in the future? And the answer is no, I don't know. But I do believe that this market is very undervalued right now, and the bull market has not reached its top.
Now, you both discuss in the book about building a precious metal portfolio. I guess starting with Chris, did you want to discuss about maybe the ratios of physical gold and silver mining stocks and other things that people should think about when building their precious metal portfolio?
Sure. The percentage of physical metal to mining stocks, that varies from person to person. And, I think the first thing you want to do is, for everyone personally, decide what their ideal amount of physical gold and silver is to have. And first, reach that. And then if you have money left over, then, you start investing in mining stocks. And that could mean even a 90-10 split of physical gold to mining stocks, or, depending on how much money you have and plus the money you save and can invest in the future while they're still cheap. It could be 50-50, it all depends. But, the main point we try to get across is a few things. First is, the physical metal trumps all. Even if you get better returns from the mining stocks, the physical metal's a lot safer because it's a tangible physical asset. And then we also emphasize pretty heavily about, to invest in some degree in royalty and streaming companies, like the Franco-Nevadas and the Silver Wheatons of the world. That's especially good for, those who really aren't familiar with the mining industry, just because it's inherently more risky than most every other industry.
Now, turning to David, did you want to discuss a little bit about silver mining stocks? You talked about in your book that in the 1970s bull market, silver mining stocks performed tremendously well. What do you see happening for silver mining stocks in the current bull market?
I think we're going to see a situation this time where we might be bidding up the price of gold and silver in the physical realm beyond what a lot of people are willing to pay. And that will spill over into the mining sector. And even if I'm wrong on that presupposition, what I think I'm very correct about is how bull markets manifest. And what happens is it starts and then it gains momentum and more momentum and more momentum. And it gets into be a manic buying. And this is what took place if you look back at the housing bubble. This is what took place at the tech bubble. And this will happen on a global basis in the precious metals. People are generally going to do what's the easiest for them to do. And even though the stock market is at new highs, there is a counterbalance in the metals and the mining shares. And what will take place as the market goes down and the metals start going up is that people will buy any stock that has gold or silver in its name. I witnessed this during the first bull market at the end phase of the bull market, meaning about the last few months of the market. And I have an example that we didn't put in the book, but the idea is that people will say, the gold price is rising every day. Oh my goodness, look at silver. The gold-silver ratio is down to 30. I knew I should have bought silver when it was at 40, or whatever goes through their heads. And they'll look for the easiest, quickest way to get into the market. And even with the internet, a lot of them won't do much research. They might get to the website and they might write something with some heavy copy that sounds really, really great, written by some promoter that really knows how to entice or tell a story, and that's all it is. But you'll find a panic buying, I think, this time, like last time, except it'll be accelerated because of the internet and because of the easy access that most people have to an E-Trade, Scottrade, Ameritrade. I'm leaving some out, but the electronic platforms that most people have, even if they only have a small account, and I don't know what that means, I'll just use like $500 as an example. When the panic hits, the manic buying phase takes place, there'll be people with small few $100s that will bet that money on a silver or gold stock or two just because they want to get rich now. Just like what happens in the real estate market. And so I think that it's going to be very difficult for Chris and I and David Smith to be able to tell our people to exit these markets while they're so hot, because most people's psychology gets so strong that it can only go up, that it's very difficult to take them out of the market into that strength. But I've traded commodities for so long, I think for me personally, I will be able to do it, and people will be upset because they're not getting the tippy top, bid. But I've learned from my own experience for years that, you want to leave some for the next guy. You want to be able to be happy with your profit. You never go broke taking a profit, all those old adages that are true, because selling into strength is difficult but must be done. So that's what I see. I see a huge bull market in the shares, way beyond what we saw before. Now, because of the ETFs, it may dampen it somewhat, and I've thought about that. But I still believe that the shares will go because people love cheap stock. And when they see gold XYZ or silver and gold ABC stock, and it's only 12 cents, these promoter types that are going to be scamming the market real heavily as it starts to accelerate near the top, they'll be pushing, they'll have more people than they know what to do with that'll want to pour into those cheap stocks that are, for the most part, worthless. But the overall sector, the really good companies, will be pushed up as well, because you'll have sophisticated money that knows what it's doing that will be pouring into the $1 billion plus market cap stocks, and they'll take them from 1 billion market cap to 2 or 3 or 4 or 5 billion dollar market cap, because there'll be a panic to get into a liquid company that actually owns money. And that's what the thought process will be, whether they know it at a conscious or unconscious level. That will be the driver.
All right. Well, Chris Marchese and David Morgan, thank you so much for joining us today. Before we let you go, did you want to share with the viewers where they can find your book?
Yeah, sure. The book's easy to find on Amazon, and we have a web page set up. It's called thesilvermanifesto.com. And for all the readers of finance or listeners of financeandliberty.com, we have in the book, there's a page that will give you a discount of 25% on the Morgan Report. So that's something to bear in mind. But there are some issues going to Canada, which we're resolving. There will be an electronic version out shortly, and we're working on an audio version. So if you want the audio version or you're waiting for the electronic version, I'll just tell you, go ahead and just wait probably a couple weeks or so, and you'll be able to get those versions of the Silver Manifesto.
This video was brought to you by ReluctantPreppers.com. Click here to watch Reluctant Prepper's interview with David Morgan. Now for a clip from the interview.
It isn't that I'm such a silver bug. I'm a silver bug because that's what history teaches. It's not that I decided, silver's the greatest thing out there. No, people have voted through thousands of years of what the best money is. The argument that money could be anything is true. But if you look at what the vote has been, the vote is overwhelmingly silver and gold. That's the vote. That's the real democracy, if you will. That's the lesson to be learned here. The vote through history is that those two metals, beyond anything else, have served their purpose as money more than anything you can name by far. And if you look even deeper, silver has done so far more than gold.